presenting the report. Subscribe for latest on financial crisis, oil price, global economic collapse, dollar collapse, gold, silver, Bitcoin, global reset, new world order, economic collapse, economic news, political, geopolitical news. Today, we talk about Wall Street banks warning signals, imminent market crash. When the big banks warn of an impending market crash, it's time to pay attention. An economic downturn is imminent, according to three major banks in the know. Investors should be especially fearful that a market crash could present itself sooner rather than later. After all, the major banks don't issue such warnings lightly. They have securities to sell you. The fresh warnings come from a trifecta of major global banks. HSBC Holdings plc, ADR, NYSE HSBC, Citigroup Inc., NYSE C, and Morgan Stanley, NYSE MS, all see mounting evidence that global markets are in the last stages of rally mode during this business cycle. Once the cycle goes negative, aka recession, markets can only go down. Why? Because corporate earnings typically crash 50% or more during garden variety recessions, even more during hard recessions like the one following the US housing bubble. Peak to trough earnings fell over 90% during that one. Analysts at these banks particularly note the breakdown of long-standing relationships between stocks, bonds, and commodities. Sentiment indicators also highlight investor disregard of historically high valuations and tepid economic data. The conclusion: stock and credit markets could be in for a death-defying drop. Equities have become less correlated with FX, FX has become less correlated with rates, and everything has become less sensitive to oil, points out Andrew Sheets, Morgan Stanley's chief cross-asset strategist. When asset correlations start breaking down, it points to distress in markets. According to the analysts, investors are pricing risk based on individual assets instead of the broader drivers. It doesn't seem to matter how tepid the economic data is. Investors are looking for reasons to stay bullish, instead of listening to what the market data is saying. The data confirm the idea that we're in a late cycle environment, and it's no accident that the last time we saw readings this low was 2005-07, wrote Sheets. In other words, normalcy bias is causing smart people to think irrationally. What is normalcy bias? It's a mental state that people enter when facing a disaster. It causes people to underestimate both the possibility of a disaster and its effects, on the basis that things will always function the way things normally function. As the market moves up in a straight line for years, it causes people to believe activity is normal. Investors also become addicted to their bulging portfolio gains, and wish or hope that the gains can continue. The problem is, it cannot continue. A broad economic slowdown, combined with the Fed's stated goal of paring its balance sheet, could decimate the market. The normalcy bias that people become accustomed to could shatter like glass on concrete. Unless they're prepared for it, investors can easily become trapped. Are corporate earnings being disregarded? As all investors know, stocks are valued on future discounted cash flow. In a nutshell, it means the higher the stock's future revenue streams, dividends, earnings, or cash flows, the higher the stock should trade on a net present value basis. Corporate earnings are the biggest driver in this equation. But presently, corporate earnings don't seem to matter to investors. This is signaling that something is amiss in the markets. Although corporate earnings have been essentially stagnant since 2012, stock markets keep driving upward. Valuations are being expanded without sound reasoning. This has experts concerned. Bank of America Merrill Lynch's head of U.S. equity and quantitative strategy, Savita Subramanian, sees a similar phenomenon taking place. She believes that investor apathy over stagnant earnings is a sign that a global stock market crash could occur. According to her research, companies that exceeded analysts' profit and sales estimates across 11 sectors saw no post-earnings bump in prices. This is the first time since the mid-2000s that this happened. If good earnings reports can't move the needle in the post-earnings trade session, the market is already discounting the news. Moving to the credit markets, the situation isn't much rosier. HSBC published 7 leading or coincident indicators that exemplify how mature this business cycle really is. Everything from yield curve flattening to stock market cap to GDP was measured. The results: 4 of the 7 indicators showed the business cycle in the late stage, while 3 of the 7 indicate mid-stage. There's little doubt that the sunset on the third longest business cycle in history is grinding to a close. In the end, the big banks are worried about equity valuations at this late business expansion stage. We've said it numerous times on Lombardi Letter before, high valuations and recession make terrible bedfellows. They cannot, and will not, coexist when corporate earnings start crumbling. When the market conclusively realizes that a recession is drawing close, the volatility and unwinding will happen. According to the banks, a market crash is just a matter of when. 5 big ideas that made the week interesting, and the stories behind them. 1. We could be close to a downturn. The rally looks like it's about to peter out, say analysts at banks like HSBC Holdings plc, Citigroup Incorporated, and Morgan Stanley. They're looking at the relationships between stocks, bonds, and commodities, and they're worried people may be ignoring fundamentals. Just like they did in the run-up to the 2007 crisis, investors are pricing assets based on the risks specific to an individual security and industry, and shrugging off broader drivers, Bloomberg's Sid Verma and Cecile Guccia report. 2. The new iPhone won't blow you away, not with anything revolutionary, anyway. There's still a lot of sizzle and improved features in the iPhone 8. The device will be more powerful, the cameras will work better, and you'll even be able to unlock it with your face. Some of the other stuff, however, is already on rival phones: wireless, inductive, charging, an almost all-screen front, an OLED screen. We don't feel an impatience to be first, Apple CEO Tim Cook told Bloomberg. Our thing is to be the best and to give the user something that really makes a difference in their lives. 3. To track climate change, listen to the frogs. This company is like Shazam for animal sounds. Wildlife Acoustics Incorporated, based in Massachusetts, sells devices that record bird arias, frog croaks, whale songs, and more. There are 36,000 of them out there all over the world, from North America to the North Pole, used by scientists to listen in on the environment. 1 lesson? Pay attention to the frog. Its disappearance from a habitat is an early warning that the place is becoming deforested, drier, or simply hotter, Bloomberg's Kyle Stock reports. 4. The U.S. Navy is shrinking. There have been 4 serious U.S. naval incidents in the Western Pacific this year, putting a spotlight on an overstretched branch of the American military. After the most recent collision involving the USS John S. McCain, some experts are speaking out about the increased burden the Navy is carrying, Justin Bachman reports. The Navy had 271 ships in 2015, 20% fewer than in 1998, and still kept 100 ships out at sea, according to Brian Clark, a senior fellow at the Center for Strategic and Budgetary Assessment. Something's got to give, said Jerry Hendricks, a retired Navy captain. Brian McGrath, another retired Navy captain, called the force thinly stretched. 5. The seeds of your midlife crisis start at 35. That's when more people start hating their jobs. When you're young, the whole world is ahead of you, and even if your job is terrible, there's hope that it will get better. By the time you hit 35, the momentum can start to slow, and things outside of work, like your family, if you have one, start to take priority. A survey of British workers showed that those over 35 were twice as likely to be unhappy at work as those under 35. The way to